Hello, this is Chuck South, Chief Operating Officer of iSectors. I wish to introduce to you Scott Jones, our Director of Business Development. Scott has led our sales and marketing efforts since iSectors' inception in 2008. Today, he is describing to you how to present our Post-MPT presentation to clients and prospects. The main presentation will be 25 minutes in length, followed by a question and answer period after the presentation. If you have a question, please type it into the box at the bottom right-hand side of your screen. Without further ado, I will now give you Scott Jones.
Thank you, Chuck. Before I get started, because this is a holiday season, I'd like to wish everyone happy holidays and a very prosperous 2016. What we're going to try to accomplish here today is I'd like to walk you through how we would explain the iSectors Post-MPT presentation. This will be a much more in-depth review than our earlier webinar today. To give you some background into why we call these models Post-MPT, which stands for Postmodern Portfolio Theory, is we're trying to convey to advisors that this, by utilizing the strategy, you're basically, what we're doing is we're implementing a more advanced application or approach to the principles of modern portfolio theory. A simple way to explain this to a client is simply that we're implementing 4 strategies with this portfolio that will help improve your client's returns with much less risk over a complete market cycle. The model is basically implementing 4 strategies, like I said. Number 1, the model is utilizing more enhanced asset allocation algorithm. It's also providing you with a improved, better way to measure risk, an improved way of diversifying a portfolio, and also a way to reduce your investment vehicle costs. Now let's take a closer look at each one of these strategies in more detail, so you have a better understanding of each one of these strategies individually. Number 1, we enhance your portfolio's asset allocation algorithm. As you well know, the traditional approach is flawed mathematically because it uses unreliable subjective input variables, where the post-MPT approach uses more reliable objective input variables, real-world input variables in our algorithm. As you well know, the traditional approach is based on the mean variance optimization algorithm, which requires you to determine the expected returns for various asset classes. Well, unfortunately, this is basically guessing. You're either guessing mean reversion or momentum, which is, they're both very subjective. So we've, based on all the research that we've done, we've felt that it'd be much more beneficial to take a much more objective approach to determine the optimal portfolio allocation on the efficient frontier. And through our research, we were able to identify 15 objective capital economic factors that we've found to have a very high impact on asset class returns. You know, there are things like money supply, GDP, interest rates, unemployment, capitalization, inflation, dividend yields, and so forth. So instead of having to guess subjectively what the expected return is for various asset classes, we use the objective inputs from these 15 different proprietary capital economic factors to help us determine the optimal portfolio allocation on the efficient frontier. Now keep in mind, Harry Markowitz, when he developed or did his research into modern portfolio theory, the reason Harry utilized a mean variance optimization algorithm was because you can calculate the efficient frontier longhand using this algorithm. But now that we have, more advanced computer technology, it gives us the capability to implement more advanced strategies, such as our post-MPT models, which are designed to provide investors improved risk-adjusted returns. The second improvement that we make is that we improve the way you measure risk. As you well know, historically, investment advisors have used standard deviation as a measure of risk. And standard deviation is a measure, as you well know, of historical volatility. Well, the problem with standard deviation is that it is flawed because it considers both upside and downside volatility to be equally as bad or equally risky. And as you know, most people don't look at excessive gains as being risky. Most people look at excessive losses as being risky or losing money. So what is standard deviation? Well, standard deviation assumes that all investments have a perfectly symmetrical return distribution. Well, everyone knows that this is an incorrect assumption. If this was true, all investments would have an equal probability of making excessive gains as they would excessive losses. And as you well know, this is not generally the rule with investments. Typically, investments have skewed return distributions, either positively or negatively to one degree or another. And unfortunately, standard deviation is unable to calculate that. This chart that you see here on the screen is an example of what I'm trying to talk about. As you can see, there are two investments, investment A in blue and investment B in green. They both have the same standard deviation of 20, but investment B's return distribution is skewed positively, or it has a greater chance of generating positive returns than negative returns, and investment A's return distribution is skewed negatively, or it has a greater chance of producing negative returns and positive returns. So if you're using standard deviation as a measure of risk, most people would probably throw out both of these investments because of the high standard deviation, when the reality is you really don't want to throw out investment B because it's skewed, the return distributions are skewed positively. You would want to throw out investment A, but using standard deviation as your measure of risk, it doesn't have the ability to filter investments based on its skewness. So how does a real world investor look at risk? Investors know that unexpected returns are a good thing and only unexpected losses are bad. So how do most investors define risk? Well, as you well know, that's usually, don't lose money. And so an improved methodology would consider only downside potential or the potential for unexpected losses as bad, and any investment with a potential for unexpected gains, regardless of the standard deviation, would be considered to be a good thing. So how does iSectors measure risk? Well, iSectors measures risk by only looking at downside or negative returns. Downside meaning don't go below zero or don't lose money. So when choosing an optimal allocation, the iSector Post-MPT models attempt to find the best potential returns without losing money. And the Post-MPT models increase your potential returns by only looking at an investment universe that has investments in it that have a greater potential for generating positive returns, and basically omitting all investments in its universe that have the potential for generating a greater potential for generating negative returns. Keep in mind, when Harry Markowitz was developing the mean variance optimization algorithm, the reason he used standard deviation as a measure of risk back in the late 50s was because you can calculate standard deviation longhand. But it was clearly pointed out, if you read his research paper, that standard deviation was not meant to be used as a measure of risk in the real world. But unfortunately, the industry has been using it as a measure of risk. But now that we have access to powerful computerization ever since the 1990s, we now have the computer power to measure don't go below zero, which we use negative semi-variance to measure don't go below zero in our post-MPT models, which requires a powerful computer to calculate. So improvement number three, deals with improving your portfolio's diversification. So what exactly is diversification? Well, it's a risk measurement technique that mixes a wide variety of investments within a portfolio. And diversification strives to smooth out unsystemic risk events in the portfolio so that the positive performance of some investments in the portfolio negate the negative effects of negatively performing investments in the portfolio. Therefore, the benefits of diversification will only hold true in a portfolio if the investments that make up the portfolio are truly different. What is the key to diversification? Correlation. As you know, correlation describes the degree to which two investments are either similar or different. You know, the traditional approach that has been used by advisors to allocate portfolios has been, or the asset classes that have been typically used by advisors to diversify portfolios are your traditional cap style weighted asset classes, your large, mid, small cap, growth value, and core asset classes. Well, as you probably know, these asset classes have become very highly correlated over the last 20 years, and they're starting to converge on one. And in a down market, when you really need diversification, reduce risk, they actually do converge on one. So by utilizing or diversifying a portfolio amongst these asset classes, you're really not able to take advantage of the benefits of true diversification because those asset classes are too highly correlated. To give you an example of how to explain diversification to a potential client, I put together a couple of slides. If you can imagine, I don't know if any of you have been to New York, but in New York they have a lot of street vendors. So imagine there are two New York street vendors and they both sell umbrellas. Street vendor number one sells umbrellas and raincoats, and street vendor number two sells umbrellas and sunglasses. Well, street vendor number one, you know, selling umbrellas and raincoats, are these product lines different? Yes. But do they help them reduce risk when it's sunny outside or when the weather changes? No. When it's raining outside, this vendor sells lots of umbrellas and raincoats, but when it's raining outside, he has nothing to sell. So he undergoes tremendous volatility from one day to the next, depending on the weather, which can be synonymous with the stock market. So this vendor would be kind of similar to someone investing in a broadly diversified portfolio of cap style weighted asset classes. Yes, those asset classes are different from one another, but they're too highly similar to reduce risk when the weather changes or when there's changes in stock market volatility. So if you look at street vendor number two, this street vendor has two products that he sells, one umbrellas and the other one sunglasses. You know, this is a much better product line to sell because regardless of what the weather is like, he has something to sell and thus reduces his volatility above zero. When it's raining outside, he sells lots of umbrellas, and when it's sunny outside, he sells lots of sunglasses. So he doesn't undergo the tremendous volatility that street vendor number one goes through. Now, this would be synonymous with what it would be like for someone to invest in the post-MPT models. And if you were to ask one of your clients, you know, which one of these vendors would they rather be, you know, most of them would probably say, I'd rather be in, you know, vendor number two, because I don't want to, you know, undergo that tremendous volatility that vendor number one is going through. So let's take a closer look at the correlation of the traditional cap style weighted asset classes. As you can see here, this is a correlation matrix of those cap style weighted asset classes, and you can see that they are all very highly correlated. You know, they're I think the lowest combination here is 0.87. And if you look at the next slide, it shows you a correlation matrix of the asset classes that we use in the post-MPT models. And you can see the asset classes that make up the post-MPT models in the far left-hand column. But you can see there that, you know, some of these asset classes are negatively correlated, low correlated, or most of them are moderately correlated. So the entire correlation of all of these asset classes is significantly less than the correlation of the asset classes typically used, you know, the traditional cap style weighted asset classes. So by using the asset classes that we utilize in the post-MPT models, you're truly able to uncover the benefits of what diversification is meant to accomplish. The fourth improvement that we make is that we reduce investment vehicle costs. As you well know, active management, and this has been verified in a number of research studies, that active management costs more and the returns are lower than passively managed funds. And a significant reason that explains why active managed mutual funds underperform their indexes is because of the high costs. So what's the solution? Well, we believe ETFs are a great passive solution. Why? Because ETF fund companies cost less to operate versus actively managed mutual funds who have to pay a fund manager to operate the fund. ETFs don't need to hold cash for investor redemptions, so you remain fully invested for more precise asset allocation. ETF managers don't have to sell stocks in their fund to meet shareholder redemptions like mutual funds do, so you avoid the internal trading costs incurred by mutual funds. And then ETF investors are not affected by the activity of other shareholders. When you own an ETF, it's just like owning an individual security. It's in your name. Unlike a mutual fund where your investments are pooled together with all other investors in that fund. So as a result, ETFs have greater tax efficiency. You avoid taxable year-end capital gains distributions, which mutual funds are required to distribute equally amongst all investors within the fund, regardless of whether or not you've added to the fund or took any distributions to the fund throughout the year. ETFs can also be bought and sold whenever the market is open, so they're much more liquid than mutual funds, which can only be sold at the net asset value at the end of the trading day. So the savings in a mutual fund, the savings in an ETF can range anywhere from 2 to 3%. And to break down exactly where those savings are coming from, you can see here on this slide that management fees inside an average actively managed mutual fund can range anywhere from 1 to 1.5%. ETFs don't have management fees because it's an index, but they do have administrative fees, which can range anywhere from 0.07 to 0.7%. But as you can see, it's much less than having to pay a manager in an actively managed mutual fund. ETFs don't have transaction costs because, again, it's an index, representing an index, where an actively managed mutual fund, on average, incurs anywhere from incurs in transaction costs anywhere from 0.5 to 1% as a result of all the trading that goes on inside the fund over the course of a year to implement their specific strategy. And then finally, ETFs don't have pass-through capital gains taxes here again because there's no trading going on. And these pass-through capital gains taxes inside an actively managed mutual fund can average anywhere from 0.5 to 1.5% of the cost of owning that fund throughout the year. So when you add up all these fees and compare the two, you can see that by utilizing an ETF versus a comparable actively managed mutual fund, you can save 2 to 3% in fees. So what does this mean? Well, basically, it means that an active manager has to outperform their respective index by 2 to 3% just to break even. And in this day and age, that's very difficult to do. Most managers aren't able to do that. So why pay for active management? Why not just take an index approach? To share with you how powerful a 2% savings in investment costs can actually be to an investor's portfolio, I want to illustrate a case study here of what that 2% cost savings looks like over a 30-year period. Let's take two investors, Bill and Jim. They're both 30 years old, and to date, they both saved $10,000, and they want to retire at age 60. So they both invest in an IRA and save $416 a month, or $5,000 a year for the next 30 years. The total investment over 30 years is $160,000. Well, Bill invests in an allocated portfolio of managed equity funds, while Jim invests in a similarly allocated portfolio of equity indexed exchange traded funds. The results over a 30-year period result in the mutual fund portfolio produced an 8% average annualized return. However, because of the lower fees, the ETF portfolio produced an average annualized return of 10%. So at age 60, Bill's actively managed mutual fund portfolio accumulated $730,000, while Jim's passively managed ETF portfolio with a 2% savings generated $1.14 million. So you can see that 2% savings compounded over 30 years is worth almost 50% more over a 30-year period, which is, obviously quite substantial. So to summarize what we're doing in the post-MPT models is basically every month the model is rebalanced. We've looked at rebalancing on a weekly, bi-weekly, monthly, bi-monthly, quarterly, annual basis, and our research has shown that rebalancing the portfolio on a monthly basis was the most optimal time frame. So what we do at the end of every month is we collect the inputs from these 15 different proprietary capital economic variables that we've identified and which are reported by the government every month. We collect that data and we input that data into the algorithm, and we basically tell the algorithm based on this data and a change in the data, how should we allocate the portfolio to these 9 low correlated asset classes that make up the post-MPT universe in such a way to take maximum advantage of upside volatility without going below zero. And so then the portfolio will come up with an allocation up to these 9 asset classes. It doesn't necessarily allocate to all 9 asset classes. It may only allocate to 3 or 4, depending on the given situation and the market environment. And the maximum allocation to any one of these 9 asset classes is 30%, except for bonds. The maximum allocation of bonds is 50%. And the difference between the post-MPT growth and the post-MPT moderate allocation is that the post-MPT growth model can use up to 33% leverage in any one of those 9 asset classes, only if the model feels it can generate more outperformance without taking on any additional risk. Where the post-MPT moderate allocation is the same algorithm, but it basically starts at a lower place on the efficient frontier and doesn't use any leverage whatsoever. So to summarize, these 4 improvements. Number 1, the post-MPT models use a more robust, enhanced, scientifically advanced asset allocation algorithm that looks at over 15 capital economic factors to determine the optimal portfolio allocation. Secondly, it uses a better definition of risk. It uses don't go below zero to measure risk versus standard deviation. Thirdly, the model allocates to a portfolio of asset classes that have much lower correlation to one another. So it's able to uncover the true benefits of diversification. And then finally, the model is able to help you reduce investment vehicle costs by using ETFs versus actively managed mutual funds. So this concludes my presentation and the explanation of the post-MPT models. If you have any questions, feel free to input those on your computer, and I'd be more than happy to answer them for you. Thank you very much.
Thank you, Scott. As Scott indicated, if you have a question, please put it into the box on the lower right-hand side of your screen, and we will answer the questions. We have some questions here. First, Scott, you referred to having leverage in the post-MPT strategy. How do you get leverage in a post-MPT growth strategy?
We get our leverage using 2-time ETFs. We don't use borrowed money because using borrowed money is much more expensive.
Okay, and harder to do.
And harder to do, exactly.
Yeah, okay. The second question we have is that if you don't, the first one we have is if you don't use standard deviation as risk, does that mean that post-MPT has a higher standard deviation than traditional portfolios?
Well, the post-MPT models use negative semi-variance as our measure of risk, which is basically measuring don't go below zero. So we don't, standard deviation really is, standard deviation is not a bad thing if the return distributions are skewed positively. So by using negative semi-variance as our measure of risk, the model is basically throwing out all investments in its universe that have negatively skewed return distributions. It only looks at the ones investments that have positively skewed return distributions or a greater probability of generating positive returns. So it really doesn't matter what how high the standard deviation is for an investment, because if the return distributions are positive, that's a good thing.
Okay. The next question is, what has caused increased correlation of traditional asset classes over time?
Well, the reason the asset classes have become highly correlated over time is because there's been a lot of overlap in the investments amongst your traditional cap style weighted asset classes. For example, if you're a large cap growth manager and your large cap growth fund is underperforming its benchmarks, say this year, and you got to keep in mind that these fund managers are paid significant bonuses that probably are multiples of their salary for achieving their benchmarks or exceeding their benchmarks. And so, for example, say this year I'm large cap growth fund manager, and large cap growth funds are just out of favor, and say mid cap growth funds are more in favor. Well, to boost my returns so I can hit my bogey and get my bonus, I'm going to invest in some large cap growth funds in my portfolio to boost my returns, because large cap growth funds are in favor. So that's why you see low overlap from your mid to small cap and to your mid cap to large cap funds. The same thing. I mean, small cap growth could be in favor and mid cap growth could be out of favor. So that mid cap growth manager, he wants to get his bonus for the year, so he's gonna, he's gonna have some, he's gonna want to invest or do whatever he can to boost his returns, and the best way to do that is to, have some drift into some of the other, growth areas, either, large or small, depending on what's in favor at that particular point in time to boost his returns. So over time, you're seeing that you've caused a lot of overlap in investments amongst those various asset classes.
Okay. Again, if you have questions to ask, please put them in the chat box in the bottom right-hand corner. The next question is, the performance numbers I see on a platform shows results, and I assume results, especially for the post-MPT growth, that trails the S&P 500 for the 3- and 5-year periods. What about the conditions during these periods have caused these results?
Well, the post-MPT models are designed to outperform their benchmark, which is the S&P 500, over a complete market cycle. If you look at our returns since their inception in February 2005, we have outperformed the S&P by over 2% on an annualized basis. The model is going to underperform at times. I mean, it's not perfect. I mean, no asset allocation model is going to be perfect. There are times when the market has gone down, such as the third quarter 2011. I don't know if you recall, but the market dropped about 14% that quarter. Our post-MPT model was up 14% that quarter. So typically the model will outperform. When it does outperform, it outperforms a lot. And when it underperforms, it's usually minimal underperformance. But over time, over a complete market cycle, I think you'll find that it will outperform with much less risk.
Yeah, and historically, the model outperforms more in down and flat markets, And of course, before this year, 4 of the last 5 years had double-digit returns. And so it's been a case where you should just have been in index funds if you knew that was going to happen. But because the whole point of the model is protecting returns, it tends to outperform the best and the most in down and flat markets.
I mean, keep in mind, the model is playing offense and defense simultaneously. So when we're rebalancing the portfolio, the model is always trying to achieve the greatest return, come up with, give us the allocation that's going to generate the best return, but simultaneously without losing money. So, when the market's going straight up, we're always going to lag a little bit. But where it really shines is during down markets, and that's when most investors really want to minimize risk, and it does a great job at doing that.
Okay, the next question: have there ever been any market conditions that would prompt iSectors to change the allocation sooner than monthly?
Well, we've back tested the model back in 2004. I mean, we've looked at, rebalancing it monthly, bi-weekly, monthly, bi-monthly, quarterly, and we found that the best time frame for optimizing or rebalancing a portfolio was monthly. I mean, if you do it, shorter time periods, I mean, you have a chance to get whipsawed. And you incur more trading costs, and doing it longer, I mean, you give up some return by doing it, having it a longer time frame as well. So, our research has shown that doing it monthly, over a long time period is the optimal rebalancing period.
Yeah, so we don't rebalance based on market conditions at all. It's purely based on
we're not. This is not a market timing strategy. It's not sector rotation. We're just implementing these 4 strategies that I discussed. We're implementing the principles of modern portfolio theory in a more sound, scientifically advanced, mathematical way. So we're not trying to be tactical. We're not trying to guess. This algorithm is 100% objective. It's a 100% objective, quantitative, rules-based algorithm. There's absolutely no subjectivity in this algorithm whatsoever.
Okay, well, we're at the end of our time here. Thank you all for being with us today. We will be sending you a link to a recorded copy of this webinar along with our Post-MPT presentation to your email, so that you can use it with your prospects and clients. If you have any further questions, please contact us at 800-869-5164. That's 800-869-5164. Thank you very much for attending, and have a happy holidays and a prosperous new year.